Ether climbed to its highest level in nearly 2 months during the midst of a software upgrade that will trim the pace at which fresh tokens are minted. The most important finance news today by MasterDigest. Cryptocurrency prices today surged, with Bitcoin surging nearly 3% to $39,267, while the second biggest cryptocurrency after Bitcoin, Ether, was up more than 6% to $2,677, as per CoinDesk. Over the past 24 hours, the digital currency Ether climbed to its highest level in nearly 2 months, during the midst of a software upgrade that will trim the pace at which fresh tokens are minted. Still, Ether is well off its record highs, reported Bloomberg. Dogecoin, on the other hand, rose over 1% to 19 cents, whereas other cryptocurrencies like Cardano, Stellar, XRP, Litecoin also surged over the last 24 hours. A lot of crypto investors took advantage of the recent spike in Bitcoin and booked profits worth $2.09 billion last week, suggesting that there is a belief that the recent spike in the world's biggest cryptocurrency was only a bearish relief rally. EU fleshes out plan to finance transition to a green economy. The European Commission adopted a package of measures to help improve the flow of money towards financing the transition to a sustainable economy. Once it is adopted by co-legislators, this proposed regulation will set a gold standard for how companies and public authorities can use green bonds to raise funds on capital markets to finance such ambitious large-scale investments while meeting tough sustainability requirements and protecting investors. This will be useful for both issuers and investors of green bonds. For example, issuers will have a robust tool to demonstrate that they are funding legitimate green projects aligned with the EU taxonomy, and investors buying the bonds will be able to more easily access, compare, and trust that their investments are sustainable, thereby reducing the risks posed by greenwashing. The new EU GBS will be open to any issuer of green bonds, including companies, public authorities, and also issuers located outside the EU. US automakers say they aspire to up to 50% of electric vehicle sales by 2030. Detroit's Big Three automakers plan to announce on Thursday that they aspire to have 40 to 50% of new vehicle sales by 2030 to be electric models, as they call for billions in US government assistance to meet aggressive targets. Sources briefed on the matter said other automakers are expected to separately make similar announcements regarding sales targets for electric vehicles as consumers begin warming to EVs and as auto manufacturers lay heavy bets on new technology, the people said. This industry is going to spend $330 billion over the next 5 years on electrification alone, said John Bozzella, president of the Alliance of Automotive Innovation, the lobbying group for automakers and suppliers, at a conference Wednesday. Even in Washington, D.C., that is real money. Even so, the sales targets are predicted on increased support from federal and local governments, such as increasing the availability of charging points and providing purchase subsidies, the people said. Federal lawmakers are proposing up to $7.5 billion for states and municipalities to build electric vehicle charging stations as part of the infrastructure bill moving through the Senate. VW to hit finance profit target years early on used car boom. Volkswagen's AG financial services arm expects to reach an earnings target 4 years early thanks to surging demand for used cars. The division will generate an operating profit of €4 billion, $4.8 billion, already this year rather than in 2025, according to Chief Financial Officer Frank Fiedler. First half results rose to a record after the semiconductor shortage disrupted production of new cars, shifting demand to pre-owned vehicles. Fairly new used cars are in demand, meaning we're getting higher prices for them than planned, Fiedler said in an interview. Certain used cars are going to go back into another leasing cycle because we don't have new cars available for our customers. UK Fintech is growing at an alarming rate, with the sector attracting $5.7 billion worth of investment in just the first 6 months of 2021, according to a recent report by Innovate Finance. From revolutionizing credit scoring and streamlining payment processing, fintechs have and are continuing to make a huge impact on consumer finance. Fintechs allow customers to use apps where the technology is far more advanced than what high street banks can keep up with, said David Beard, founder of Lending Expert. The basic basic loan product is certainly becoming more digitalized, he said. We have been eager to see the opportunities arising from open banking that should be able to provide better credit scoring and more personalized products for things like loans and mortgages. The fintech sector has taken significant strides in overhauling financial services, with the insurance industry seeing the traditional brokering process streamlined by digitizing key processes, according to Simon Taylor, founder of Get Indemnity. Taylor expects the insurance market will follow in the footsteps of the banking industry and allow for better connectivity through APIs. Banks around the world have significantly scaled back their bricks-and-mortar infrastructure as the growing popularity of low-cost online banking forces a rethink of their business model. The number of physical bank branches in roughly 100 countries with comparable data has dropped by 56,000, or 14%, over the past 10 years, according to International Monetary Fund data on commercial banks. The US shed 1,500 in 2020 alone, while bank-heavy Italy dropped 800. Japan's finance industry, which has been slow to embrace virtual banking and had largely resisted this trend, looks set to change. A Daiwa Institute of Research survey of public disclosures from major and regional banks shows plans to close about 1,000 branches over the next several years, nearly 10% of the nationwide network. Highest proportion of at-home workers are in finance and insurance. Working from home since the pandemic began has varied substantially across industries, with the highest rates observed in finance and insurance. Based on StatsCan labor data from April 2020 to June 2021, the finance and insurance sector had the highest proportion of professionals working from home, about 73%. The professional, scientific, and technical services sector closely followed, with about 70% of employees working from home. In contrast, about 5% of workers in accommodation and food services worked from home during the period. Employees of large companies, 500 people or more, were also more likely to work from home compared to small ones, fewer than 20 people. Accordingly, many companies in finance and insurance have already announced plans for hybrid, both at the office and at home, or fully flexible work. Other factors affecting rates of working from home were earnings level and education. Both the highly paid and highly educated were more likely to work from home. Thank you very much for watching. If you liked this video, please like and consider subscribing. Also, share this video with your friends if you feel so, and please put your opinion down in the comments. If you want to know more about finances, please check the links below.